I'm Casey Marks, founder and CEO of Crown Haven Wealth Advisors, a local independent fiduciary retirement planning and wealth management practice here in Carmel, Indiana. Today we're going to be talking about interest rates and how that's affecting our overall economy. I've got a client of mine in the office today, and they're going to be asking me some questions just regarding that and how it's all impacting the economy, and I'm just here to answer those questions. So it's going to be a very interesting conversation, and anybody that's interested in it, we want to hear what you have to say. Comment, like, if you disagree with what we have to say, let us know too. But don't be one of those guys who just gives us a thumbs down and we don't know what you think. Let us know what you think. It's valuable information, and that information should be shared. So we'll kick it over to Mike here. And what kind of questions do you have about the interest rate environment right now, sir?
Yeah, I came in. One of the biggest questions that I've got is, I watch the news, and a lot of times recently the news is talking about the Federal Reserve increasing rates by like 0.75%. Is maybe the thought, how is that going to impact, what my investments are doing, and just the overall big picture for my overall retirement.
Yeah, so typically, and that's a great question, and this is the Federal Open Market Committee and the chairman of the Federal Reserve is coming out and they're saying, hey, we've got to raise interest rates. So why are they raising interest rates, right, is the first question that we have to answer. So if we go back to the coronavirus, we had supply chain disruptions, major supply chain disruptions, which caused significant demand where supply wasn't there to fill it. And so as a result of that, and the monetary stimulus that occurred during the latter parts of the Trump administration and the beginning part of the Biden administration, it incurred a lot of monetary flow. At the same time, supply was really squeezed, which created inflation. So now, and inflation, for those of you who aren't familiar with what it actually does, it's essentially a regressive tax. So it's making the value of your dollar, your buying power, less valuable in real time. And the 105-year average of inflation is 3.1%. So right now, the June report of inflation that came out, it's July of 2022 right now. The June report that came out and said, hey, 9.1% inflation, that's incredibly high. So the Federal Open Market Committee and the Federal Reserve is going to have to respond to this. Why? Because things get more expensive when inflation goes up, things like gas, et cetera, et cetera. So what they're going to do to combat that is they're going to raise interest rates, and they're raising the benchmark interest rate. So the benchmark interest rate that they're raising has essentially been kept at close to zero since the Great Recession. And the reason they kept it at zero was essentially, if you look at the economy as a whole, our GDP, which is our gross domestic product for the country, on an annualized basis is about $24 to $25 trillion, give or take. We have a debt of about $30 trillion. So if you look at that, there's a deficit of about $5 trillion. And if we understand the way debt works, if you keep interest rates really low on debt, it's a lot easier to pay that debt off, which is why interest rates were kept at zero for so long. To wrap this around to you, 10 years ago, that's why you couldn't go down to the bank, and still really can't, and get a return on any sort of savings vehicle. So if you go and try to get a CD, your CD rate that you might get is 1% or 2%. Now they're starting to kind of go up as what? The Federal Reserve raises those benchmark interest rates. So what they're trying to do is they're trying to raise these rates, which will do what? It will make the debt more expensive to service, which will discourage speculative investment. And it's really to combat inflation. So that's what they're doing. So the fallout of that is going to be every asset price, or every asset that has gone up in price due to those 0% interest rate policies are going to fall. So if you're looking at a stock portfolio, let's say, it could be large cap, small cap, mid cap, whatever you want. those stocks are going to decline. And that's what we've seen over the course of the last 6 months, the first 2 quarters of the year. And also, if you really looked at which stocks fell first, the NASDAQ, which is a high growth index, or the Russell 2000, which is an even higher growth index, fell first and fell the hardest. Why? Because the Russell 2000 is made up of companies that primarily use a lot of debt in order to grow. So when that debt becomes more expensive for them to service, their future earnings get hurt and their stock price goes down. Same thing with the NASDAQ. They're just a little bit less risky than the S&P 500, which is the major index that most people track. It's a little bit better. It's a little bit of a better mix, let's call it. The Dow Jones Industrial Average, which is only 30 companies, and they're industrials. I mean, everybody's going to still brush their teeth. They're kind of defensive stocks, but they're going to go down too because they've all been overvalued due to zero interest rates. So as the Federal Reserve raises rates, stocks go down. As they raise rates, also what happens is current bonds that are held by people, those bonds fall as well because the interest rates or the yields are inversely correlated to interest rates. So as interest rates rise, those yields fall. So a typical investor, this is bringing it all the way back to you, a typical investor that has a 50-50 stock bond allocation over the course of the last 6 months, has lost anywhere in the neighborhood of, 10, 15, 20%, all the way up to 30 to 40%, depending upon how risky they were. And why that matters is because you have a totally different time horizon than institutional investors. Institutional investors can look at this as a buying opportunity. They can say, oh, Amazon is down, 40% off of its all-time highs that they reached in the middle of COVID. And they can say, oh, well, great, Amazon's an okay company. Even though, I mean, if we're talking about Amazon, Jeff Bezos left and, Jazzy's in there and we're not sure about Amazon now. But you could still look at that and go 40% discount if you're an institutional investor and you've got a 30-year time horizon. Same thing with the housing market. You could say housing is a little bit overvalued, but I don't care. I've got a 30-year time horizon, so I'll pay 20% above what I know it's worth. But when it declines 10%, I don't care because 30 years from now, it's going to be 50% worth more than what it is right now. So you've got this battle between institutional investors, which control like literally 99.9% of all wealth, and the folks like you that everything you have is a fortune to you, and you're trying to make it work for your retirement. And, there are things that are out of your control that are happening that are directly affecting your portfolio value, which is why it's so important to use a systematic approach that reduces overall risk, that implements true asset allocation between multiple buckets, that doesn't just look at the securities bucket as the only place to put money. Because to demystify the world of finance for a second, aside from real estate, which is illiquid, that you would then have to take money out of to have utility, unless you're taking rent from it, right? If you put $500,000 into real estate, it's now in that real estate. You can't get your money out, right? Or gold or commodities or whatever like that. You put your money there, you're going to have to sell it to get utility of it again. Yeah. Or cryptocurrency. There's really 3 places you can put your money. You've got banks, insurers, and the stock market. Well, right now, if you're down at your local broker dealer or working with an advisor that only wants to charge you a fee to manage your money, what's your portfolio look like? You've got stocks and bonds. Well, your stocks and bonds are both losing value right now. And what really matters is whether or not that matches your risk capacity. Because if you don't have the capacity to take those losses in the time horizon that you have, and ultimately you're going to have to use that money to live, whether or not that's for your basic necessities or for the type of life that you want to have, whether it's you want to go travel the United States, take some trips, whatever. It's It's going to be very important to balance that properly, which is why at Crown Haven we offer our RetireSHIELD, which is a 5-step process to ensure that that is balanced properly. But interest rates are connected to the broad economy. They're connected to inflation, you know, and it's the modern monetary theory. And I would suggest anybody watching this, and as well as you, and I'll send you the link, watch The Economic Machine, which is a video that Ray Dalio did. And if anybody doesn't know who Ray Dalio is, he's the founder and the chief investment officer of the world's largest hedge fund, and they're called Bridgewater Associates. And he did a 30-minute video. It's like The Economic Machine in 30 minutes or less. And he explains the long-term debt cycle, the short-term debt cycle, how credit works, how inflation works in relation to interest rates, and all that. And kind of it allows you to look at it almost as if we're these figures on a map and where we're at right now and what that means for us. But what it means is that, you know, there's trouble ahead. But if you've got Jamie Dimon, the CEO of Chase, out there saying there's a hurricane coming, if you've got, you know, Ray Dalio saying you better be diversified and your potential annual return in the market right now is going to be 2 to 4% with a whole lot of risk around it. That's what Ray Dalio is saying. If you've got Fed Chair Powell saying we're not worried about the market, we're worried about getting unemployment or keeping unemployment down and getting the benchmark interest rate to 2%, they're essentially saying they don't care if the market crashes. And you got Janet Yellen, the head of the Treasury Department, essentially saying the same thing. What that means is that all asset prices are going to dip. So you could be standing, you know, on train tracks with a train coming 10,000 miles an hour towards you and you don't even see it coming right now. And the trick with this whole thing is what happens before a crash? There's usually a bubble. And people are very happy when there's a bubble. People think everything's fine until it's not. And that's kind of what we've been experiencing. There's been a lot of social turmoil in the United States. We've never been more divided than now, except for maybe the Civil War. But, you know, most people have been doing okay over the course of the last decade, aside from, you know, COVID, which was absolutely terrible. But easy monetary policy, we haven't seen 0% interest rates the way that we had them really many times in our country's history. So it's been very easy sailing for a while, and it's about to turn. So that's what's happening.
That makes sense. Appreciate it.
Yes, you're welcome. My goal here is to provide value to everyone out there, and you know, on the internet, and we're still going, right? On the internet, look, you can find clickbait and you can watch that if you'd like, but if you want to go through the actual thought process of something, it takes a little bit of time. If you've made it this far in the video, congratulations. It takes a lot of time and energy, and you probably had to go back a couple of times. And if you didn't, then that means you're on point. But I prefer, if I'm going to go online and watch something, I want to hear the context. So I'm never going to try to do short videos just to get clicks. Is there anything else you'd like to talk about?
Yeah, you know, and you kind of, so possibility of recession, you bring that up, you know, in your last explanation.
And,
you know,
and I can be more concise if you'd like me to be.
But so you talked to, you know, that troubles are coming, and you explained that very in depth, and I appreciate that because that's, you know, that makes sense to me now. When do you think, you know, I know nobody has a crystal ball. I don't know when.
I've got one on my desk, but I don't use it. It's just there. It's there for posterity. It's a joke.
When do you think that's going to happen?
So here's the thing. I don't think anybody truly knows. It's not a matter of when. It's going to happen, or it's not a matter of if, it's when, right? So it's going to happen. Um, here's what I do know. You can't kick the can down the road forever, and we've been kicking the can down the road for a very long time. And if you were to look at just asset prices, for example, in March of 2020, my team and I were looking at stocks. I mean, if you're familiar with value investing at all, you know Benjamin Graham, who was basically, he didn't mentor Warren Buffett, but Warren Buffett really was a student of Benjamin Graham, and that's essentially how Warren Buffett grew his empire, right? Berkshire Hathaway. So value investing is a really smart way of going about it. That kind of went out the window over the course of the last 5 years. There was no company that you could look at and say, you know, this is a good company from a value standpoint, because everybody was overvalued. So then you had a whole bunch of people, and especially in the professional investment community, going, well, forget about value investing. We're just going to look at technical momentum. We're going to look at momentum trading. And essentially, it turned into the greater fool mentality, which is very similar to like the tulip craze. And you saw that with cryptocurrency. You saw it all over the market in different areas of the market, right? So excess that is unimpeded is going to cause a fall. And we're already in a recession. People don't know that, but we're already in a recession. Listen, somebody told me recently that repos for uh, automobiles are up like some ridiculous percentage. And the reason for that is what happened in 2020. A whole bunch of people had a whole bunch of money they didn't normally have. Gas prices were really low at that point because oil had fallen off the face of the earth. Everything was really cheap. And so people, not really thinking long term, went out and got cars on credit with different layers of credit, not just one layer of credit, multiple layers of credit, with money they didn't have. So now all those cars are being repossessed. And the only reason we're not seeing the result of this right now, like as we speak, is because we still have supply issues. If you try to go get a new car right now, they're still making it across the Atlantic, right? If you're going to get a European car. If you're going to get an American car, it's tough to get too. So we still have a supply issue, but that doesn't mean the fundamentals of the economy aren't completely screwed up. And what the Federal Reserve is going to argue is they're going to say, well, employment numbers are still good. Okay, well, we'll see about that. We'll see. Because you've got a lot of companies that are looking ahead at this, and you know, it's always good until it's not. You got a lot of companies that are cutting 20% of their staff already, 30% of their staff already. There are levers that are getting pulled as we speak right now. But back to what I was saying about March 2020, there were stocks that we were looking at that had finally gotten almost close to a fair valuation. And then what happened? The Fed came in and saved the day. The Treasury came in and saved the day. We printed like 3 ice ages worth of money. And we had a V-shaped recovery. And now people think that's normal. That's not normal. That's the economy on steroids. That's not the guy who goes to the gym every day and works out and sees incremental gains over time. That's somebody who juiced themselves up and turned into the Hulk. And that's what we've been experiencing for the last 2 years. And now we're seeing the slow ramifications of it turning in the opposite direction. But when it goes down, it's not going to come back up quick next time. There's going to be a lot of pain, and people are going to have to prepare for that. So the best advice I can give anybody ahead of time is make sure your portfolio is in alignment with your risk capacity. Make sure you're using real diversification. And that means having hedges. That means being insured for a portion of your portfolio. That means having enough in emergency reserves to handle things that can occur and will occur. Emergencies happen. That means having the healthcare situation for your retirement taken care of, so creditors can't access your capital if you get sick. That means having your estate plan set up properly. All those things have to be done. Taxes are going to go up, by the way, because that's how the government's going to raise money in that recession. We're trying to avoid a depression right now, is what we're really trying to do. World economic leaders are trying to avoid a depression right now because we're battling inflationary and deflationary pressures at the same time. And unless that is managed perfectly through means of debt restructuring, fiscal stimulus, the redistribution of wealth, which is raising taxes, all these different things, unless that's done properly, see you later, alligator. That's kind of where we're at. So that's why we put together the portfolios we do for our clients at Crown Haven with the RetireSHIELD, because our clients know they're going to be okay. And that's the beauty of it.
Yeah. No, that makes sense. Thank you.
I will say, though, that you're going to see a pop. The markets are going to go up before they go down again because you've got institutional level traders that are finding those positions that they like at what they perceive to be a discount because they've got much longer time horizons. And they've got capital that they can afford to lose, and they're hedging it on both sides. They're shorting and they're long.
So those you think that by September we're going to have a little pop.
Yeah, I think the markets, I mean, you've been seeing it. The markets have kind of gone up over the course of the last week. But, you know, have you seen the movie The Big Short?
Mm-hmm.
You know Michael Burry?
Sure.
He shorted everything, and he was short for like 3 years.
Yeah.
And it was the longest 3 years of his life. Yeah. And everybody was going to leave him, and all the investors were calling him crazy. You're always crazy until you're right. Okay? He was right. And you can't argue with math. And you can't argue with irrefutable facts that are laid in front of you. And unless it's deliberately manipulated to a point of no return, it's gonna come down in a bad way. And so we had to position ourselves to be protected from that. But yeah, you'll see a short-term uptick probably. We got a lot of other things that are going on. We got geopolitical risks. We've got Russia invading Ukraine. We've got one of the biggest net exporters of oil shutting off supply to the Eurozone. Eurozone's in trouble. We've got parity between the euro and the dollar for the first time in like 20 years. If you wanted to go buy something in Italy right now, you're winning. Yeah. That hasn't happened in 20 years. You know, there's all these things that are happening at the same time. Inflation's at 9%. Parity between the euro and the dollar. The supply of oil is not where it needs to be. We're not even feeling the agricultural component of this yet, but prices from everything from grain to wheat is going to go up. So it's going to be very interesting to see how this all plays out, but it's going to be very important to have a balanced asset allocation to weather the storm. And for God's sakes, don't take on any debt right now. Don't do that. That's not a good call. Thank you all for listening and watching today. Look, at Crown Haven, I started this firm with the intent to ensure that every single person that comes through our door is protected, both against variables that they can control, which we hold on to with every fiber of our being. That's the risk we're taking, the fees we're paying, how we're setting ourselves up from a tax perspective, legacy perspective, you name it. But also keeping in mind the macroeconomic picture and how we can put ourselves in the best position for that. So legislative risks, taxes, and paying attention to what's going on in the world and how that then relates back. It's not just the numbers, that's the quantitative. How that then relates back to the qualitative, which is what you want your life to look like. Because everybody wants their life to look like something a little bit different. But as far as I can tell, after a decade of doing this, everybody wants to be happy. Happiness is going to be unique to you. It comes from fulfillment, but happiness can only exist if there's an absence of stress. And so we need to create the conditions so that there is no stress from a financial perspective, so that you can pursue what matters to you. And that's what's so important, and that's what's so crucial about having a proper plan in place. And if you're working with an advisor right now, and you don't feel a lack of financial stress, then you don't have the right plan. Because what that means is that plan is not in alignment with what your goals and objectives are. And you don't have to stay in that position. That's not the way it has to be. So we take great pride every day in ensuring that our clients' plans are in alignment with what their stated goals and objectives are. And you'll notice that our phones are not ringing off the hook right now because people are happy. So I want to thank you for listening. Comment below. Let us know what your thoughts are. We love engaging in thoughtful debate. www.crownhaven.com. Check out our RetireSHIELD program. It's pretty cool. We trademarked it. It's on file with the U.S. Patent and Trademark Office. We're teaching lots of other advisors across the country how to do it. And our clients will tell you that it is the best thing they have ever done for themselves and their families. And it's not a one-size-fits-all solution. It's completely custom tailored for you. But it takes all of these different components into consideration. So check it out. You'll like it. Thank you.